All right, good morning, everybody. It's 6:34 on Wall Street. Welcome to Quant Box Live. Well, right now we're looking at seasonality for the S&P 500, and what we can see here is that somewhere around July, the stock market tends to peak, and then it has a down month in August, and then a down month in September. And somewhere in between the September and October period, we resume an upward trend. And we're trying to do that now. But is it early in the month? Is it late in the month? It's really hard to tell. What I teach is we get ready, willing, and able to get back into the stock market around the third week of September. Um, Oh, but wouldn't it be nice to know specifically which week? Is that week 41? Is that next week? Do you guys ever notice this? No, because I added it yesterday. So QuantBox Pro now has yet another upgrade, like the 12th or 13th upgrade. And I don't even keep track anymore. And now it tells you week by week by week the seasonality, and it shows you the shape of our current stock market, the shape of the stock market over 5 years, and the shape of the stock market over 20 years. And you see dip, 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 dip. But on the 41st week, it starts to pick up again. Ooh, that's on Monday. So anyways, very cool. So let's get on with it. Beep, 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 beep. So, as I said before, welcome to Quant Box Live, where we get our global macro on. It's 3 hours before the open of trading on Wall Street. This is our opportunity to use AI to look at things like sentiment, inflation, and employment, and GDP, and technical analysis, and open trade positioning, and seasonality. We also create baskets that are risk on and risk off and watch them in real time as aggregates. So we look at VIX and the 10-year yields and gold and the dollar index and yen index, and holy smokes, we take all of this data from public and private sources and we make it so that it's easy to understand. So you wake up in the morning and you go, that looks bearish to me. Why? Well, maybe it's inflation, maybe it's GDP, maybe it's employment, maybe it's the interest rate, maybe it's seasonality, maybe it's a combination of all those things. When we look at this setup, by the way, this shows retail sentiment as well as institutional sentiment. Where do we get that? We get that from the Commitment of Traders report released by the CFTC, the Commodity Futures Trading Commission, which is a government agency. It's released every Friday, but it's just a bunch of tables. It's a spreadsheet with millions of lines of gobbledygook. We make it interesting and readable. So anyways, if you're watching this on YouTube, why don't you swing on by quantbox.co, take a trial. It's $8. And if that's not good enough, I'll tell you what, I'll throw in a macroeconomics training course and a statistical analysis training course so you understand things like, what does that dot plot mean? Yeah, neat. So anyways, let's get our macro on. Let me remind you that trading is risky, not appropriate for everyone. Past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. Okay, let me get in. Gee whiz. All right, all right, all right, all right. Loading, loading, loading. Loading, loading, loading. Okay, yesterday yield on the 10-year T-note was 4.8. Gee whiz. Okay, the 30-year hit 5. The 10-year hit 4.8. So we got a steepening of the yield curve. The 30-year pays more than the 10-year. That's good. It's good. We're reshaping the yield curve in a proper way, but the rate of which we've been reshaping the yield curve is incredible. Think of it this way: people have been dumping their bonds because they've been losing value, which makes more people to dump their bonds because those bonds are now losing value. And it's just an avalanche. So, anyways, as these yields are going up, that means the bond prices are collapsing and at a dramatic rate. I think we're about 50% from the high right now. Imagine the stock market dropped 50%. Ouch, huh? Ouch. So, anyways, dramatic move. At some point, it should be enough. Historically, 5% is about right on the 10-year T-note, by the way, just not in the last 20 years. Well, it should be about 5%, kids. Okay, so anyways, we're back there. Will it go any higher? I don't know. But at some point, somebody's going to want to own that. And I think it's going to be when money markets don't pay 5% anymore. So then you'll move money out of the short end of the yield curve and you'll plow it into the middle of the yield curve. Okay, gold is still above 1800. Remember, our target was 1800. S&P 500 had a good day yesterday, holding above 42. Remember, 4200 was our number. The next one after 4200 is 4000. And Bitcoin staying risk on. Take a look at our risk gauges, and still a bit of risk off. They were a little bit risk on, and then overnight gave a little back during the European session. So we're trying to figure things out. So the stock market, like the S&P 500, rallied all the way up yesterday to the daily 21. I think it was the daily 21. It might have been the 4-hour 21. But it makes sense for that to be a top. Over the last 30 days, the yen is down a bit. That's good. Yields. Look at this, guys. Yields are up 12%. That's huge. Big negative. Dixie is up, big negative. Okay. Gold is down. Good. Good. S&P 500 down 6%. Whoa, bad months. Okay. That's negative. And the VIX is up, 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 up. Cool. Makes me happy. Do you remember about 6 months ago I said I'm just waiting for an opportunity to VIX to spike so I can trade against it? Well, it's something I need to think about. Something I need to think about. There might be an opportunity there if we go back to normal. Just quickly bring you back to the seasonality that I added. Isn't that pretty? Okay, so you can change the asset. What do you want to do? Let's look at VIX. Okay, VIX has been going up and 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 up. Cool. Supposed to peak somewhere around October and come back down. Okay, so you can see a high, 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 down, down. So now you can look at it week by week by week. And VIX is right here. So this is where we are now, week 40. So somewhere around week 41, 42, 43. Okay, it's down. Where's my drawing tool? Where's my drawing tool? Drawing tool. Oh, drawing tool. There we go. So notice, okay, that over the last few weeks, That's what's happened over the last 5 years. That's the shape of the VIX. And over the last 10 years, this is what VIX does over these weeks. And then what happened this, right? This period went up. It did over the last 5 years, it did over the last 10 years, and it did this year. Fairly reliable, it looks like, huh? And over the last 5 years, the volatility has peaked. And look at the orange line and the blue line. That's volatility in the VIX falling, 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 falling. So next week is the peak, and then down 1, 2, 3, 4, 5, 6, 7 weeks. Remember, the motto for QuantBox is that it gives you the confidence to let your winners run. Now you can look at this and say, yeah, I might hold that short for 7 weeks, but 8? Don't be ridiculous. Huh? 8 is one bridge too far. Okay. Hey, you're welcome. Nice. It's pretty awesome. So, anyways, there you go. So, it's cool beans, as the kids say. Do the kids say cool beans? Probably not. You can look at one more. How about euro dollar? Okay. We see somewhere around October, euro dollar should rise. Should meaning, you know, long-term average, short-term average. Typically, it starts going from a bottom to an up. Well, which week specifically? Well, you can see the velocity of the down is great this year. It's huge. Okay, much more than normal. It's very, very bearish relative to normal. Over the last 10 years, it's slightly bearish. Over the last 5 years, it's fairly bearish, but then with a spike down. And this year, it's just been down, 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 down. But notice this week is the lowest low. The lowest low. And over the 5 years and 10 years start to go up next week. This week we bottom out. Ho, 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 ho. Good to know. Good to know. Now, once again, they're forms of averages, if you will, aggregates. So just remember how uncomfortable it is to have 1 foot in a bucket of boiling water and 1 foot in a bucket of ice water. On average, it feels great. But nonetheless, this is information that might just be useful. I don't know. But notice you see the shapes of the stock market on average and how repeatable it seems to be. Cool. Well, based on these averages, we've hit the bottom this week. Cool. Now, it doesn't mean it's going to be reality, but it is useful information. Okay, cool. So let's go back to reality. Mom spaghetti. Snap back to reality. Oh, there goes gravity. Opie don't chokey dopey dopey dee. All right. So what's going on? Big rebound in the Japanese stock market. Yeah. So typically you see weakness in yen. So then yen pairs should be up. And these were really way down. So CAD yen, a little bit of a recovery, dollar yen, a little bit of recovery, Kiwi yen, a bit of a recovery, euro yen, Swissy yen, pound yen. Okay, they're flat to slightly up, but not way down, which is the beginning. Oil is interesting. Okay, it's down again. Yesterday it was on that monthly M2. So technically, it was an interesting price, something that we had pointed out a couple of weeks ago. Okay. But the theory, I suppose, with oil is, well, we're pricing in that we're in a recession now. How does it feel, by the way, if we're in recession now? It's hard to tell, huh? So part of that is the job market. Is the theory like we're at the point where we're not adding jobs, and then wages are going to come down, and all that kind of stuff. Okay, so we're in recession. Cool. Okay, which means cash is king. Cash is king in a situation like that. If asset prices are falling, so bonds have fallen 50%. Some point, someone's going to want to own those assets, huh? So one of the things we talked about in the stock market course are frictions, and frictions don't exist until they exist. And when do they exist? When things when things go to hell, people throw out logic and people panic. 50% drop in the bond market in a short order smells like panic to me, huh? Cool. So, anyways, interesting. We've had a slight decline in the stock market. I don't know if it's going to continue down, but at some point, you want to convert your cash to assets. Do you think the dollar is going to be awesome over the next 10 years? Right now, we have a $2 trillion budgetary deficit, which means we're going to be adding to the debt. See, there's deficit and debt. We'll be adding to the debt by 2 trillion a year at this point. You're like, oh my God. Oh my God. And I think at this point, nobody in the government even knows who runs the budget. Like, who makes these decisions? They're like, I don't know. So how do you stop that monster, huh? I mean, that's insane. So if people move away from the dollar, okay, what are they gonna what are they gonna do with it? Well, if it weakens, you don't want to own it, so you might as well own income producing assets. Okay, Aussie. Okay, Aussie and Euro and Kiwi seem to be best performing. You can go out to those assets and take a look. Oh, boop, boop, boop. Sorry, porn. Sorry for all the porn. Econ porn. Yeah, I love looking at charts. All right. Um, I wanted to look at Aussie and Kiwi. Just take a look at the short-term indices here. Okay. Look at the volatility on that Aussie. Just cray. It's trying to hold a hold up. Okay. Pound is trying to stabilize. Aussie's trying to stabilize. CAD is just gone. Just remember how bad the economic data was, right? Okay. Denise says, if we're in recession or going in recession, why would the stock market go up? Well, maybe it won't. Okay. Maybe it'll fall further. But the stock market is already trading next year. You have to think about the stock market is anticipating next year. So the fact that the stock market is down now is that they're anticipating less earnings per share or profit, okay, or return on capital or return on equity, just less return, okay? So why would it go up? And why would this week be the bottom? Well, next week is earnings, okay? And we might find out we're a little pessimist. Maybe we're not quite in a recession yet. but we've priced in one. So then earnings might come out pretty good. Actually, like not bad. No one thinks it'll be amazing, but what if it's not terrible? Oh, well, then we'll worry about recession next quarter. Okay. And now it's underpriced. So that future value of cash flow using a model like that, where you're like, okay, let's value a company. So the future value of this company is equal to, right? No, the current value. Let's do it over again. And I'll do it in black. Okay, the current value of a company is equal to its future cash flow over 1 plus I to the 1 plus the future cash flow of this company over 1 plus I to the 2, and then plus, let's do one more year. So we're looking at 3 years of projected cash flows over 1 plus I. I is the interest rate or inflation level, okay, to the 3. So all of these are variables. We don't know what a company is going to make, in 24 or in 25 or in 26, right? But if you're a stock investor, your job is to pick companies you think will make more and more money. Now, instead of cash flow, you could do profit. Okay. You could, whatever you're measuring, it's a variable. Like, well, what do you use for your I? Is it in the inflation level? Well, what's inflation going to be in 3 years? I don't know. So, what number are you going to use? Maybe you'll use the number that the Fed is saying on the dot plots. Okay. Or maybe it's yield. So, the yield on the 10-year. What will it be in 3 years? Okay. So, now you're fixing all these variables. So, you're going to value some sort of company based on the assumption that this company is going to be profitable in the future. How profitable? Okay. And so you might say, next year it'll be profitable, but let's say 10% less than this year, 10% less than 2023. So you're like, I think we're going into recession and even this great company is going to struggle to make money. In fact, it'll make less money. Well, that's not good, right? A company making less money or less profit. So you're like, okay, so therefore the stock price is too high, and people sell it off because they think, well, it's going to be less profitable next year. So what if you find out it's actually doing really well and you change your mind? The market changes its mind. This company will actually do better next year. Not much better, but not -10. Even just zero would be better than -10. And then you're like, oops. So you redo your math and the value of this company has gone up. Okay. So people might have priced in bad results, but I'll argue that GDP, what was GDP? 2%. So we were very productive compared to the rest of the world. So maybe things are not that bad yet. And earnings will come out pretty good. And then people will readjust all their valuation models because maybe in 2024 there'll be more money made, or maybe they'll start changing the interest rate. If interest rate goes up, then this goes down. If the interest rate goes down, then this goes up. So there's all these variables that need to be changed, but it's just valuation modeling. Okay. So yeah, it doesn't make sense that the stock market would go up in a recession, but it's down and we're not in a recession. Okay. So maybe it makes the same logic. We could be in recession, but the stock market goes up because next year we won't be in recession. Okay. So, anyway, so the market's always 6 to 12 months ahead. All right. So anyways, dollar fairly strong right now. Let me update the slope of this analysis. Okay. You have to do this manually for this indicator. This is why I invented price action pivot points, because they update themselves and give you the same information. I just can't put it on this tool. But anyway, so you can see Aussie is still bullish, pound is still bearish, Kiwi is still bullish, and CAD just like fell off a cliff. Like all news out of Canada suddenly just went bad. Bad GDP, bad exports, bad inflation, bad. Okay. And now oil's dropped, which is funny because I read in some serious publication said Canada's down because oil's down. And that's remember when I was interviewed about forex by Bloomberg. I'm in the Bloomberg offices and hanging out with Sarah Eisen and Biaggi, Carol Biaggi, and stuff, and it was cool because I was there all day, so it was pretty late at night, and we're running around the empty offices of Bloomberg, and then I see Carol, and she's the one that interviewed me for forex, and she had about 5 books on her desk stacked up in her cube. Okay, stacked up. And it was just books about forex. So they're like, "All right, you're going to be the forex person." Okay. So all of a sudden, she's really good, but she's probably a journalist major, right? So read a bunch of books, and now you're the forex expert at Bloomberg. Okay. And so you got to be really careful. Like even a company like Bloomberg, you would assume everyone there has PhDs. No, everybody there has journalistic degrees, right? So you got to be very careful because it's almost like, and I forget what publication I read that thing like, oh, CAD's down because oil's down. It's almost like someone just watched some YouTube webinars and now reports to the world. Like I walked away probably 10 years ago from reading media because it was so wrong most of the time. Anyway, so let's take a look. Maybe there's some Aussie recovery here. Okay. How we doing? We had like a Euro Aussie at one point. Yeah. We had this down though, so not on this chart. I wonder where I had that. Maybe it's under Euro. Okay. Anyways, how far back does this go? July, August, September, October. All right. So these are dailies inside of monthly periods. Okay. All right. So let's readjust. So the trick with this is there's no dollar on this chart, right? Hang on, I'm going to mark these things. And I'm going to take this and mark that. There's no dollar on this, but if the dollar gets weak, euro is going to go up. It has nothing to do with the euro. So it'd be weird if suddenly euro gets strong again. What I would normally do with this setup, or what we've discussed, not on this chart, on a different euro Aussie chart, but um, we had this setup, and maybe a different time frame as well. But we had this setup going this way, and that may be true quantitatively, but if the US dollar weakens because suddenly the bond market stabilizes, the stock market recovers, the dollar would weaken because that would be risk on. The euro dollar, okay, according to the Bureau of International Settlements, which is a central bank for central banks, just like central banks are banks for commercial banks. Yeah, it's true. There is such a thing. The head of the BIS is his name is Karstens. He used to run the Bank du Mexico. Anyways, according to the Bureau of International Settlements, 40% of the entire forex market, 40% of everything we do is euro dollar. Okay. 40% of the entire forex market. And I think a lot of it was because, well, euro's kind of a reserve currency. It almost was, but it's very liquid and very deep and represents hundreds and hundreds and hundreds of millions of people in their economy. Okay, great. And a mature bond market and all that kind of stuff. Great, great, great. Rule of law, great. Okay. Um, but it's really the dollar is the reserve currency, right? So if the dollar weakens just in of itself, just as the reserve currency, which is a good thing, by the way, risk on, then just by sort of de facto, euro has to go up. Otherwise, otherwise, dollar wouldn't weaken. So to weaken the dollar, you have to have euro strengthen. Okay. Yeah. So, anyways, kind of interesting. So then you might want to like maybe not euro Aussie, Aussie yen. Okay. If you're not so sure, like that price action is ugly. There was a massive collapse when US dollar versus yen hit the psychological level of 50. So if you didn't see that coming, you got sideswiped, not by a bus, but by a freight train. Okay. Once again, many people on TV and YouTube, they're like, this is the Bank of Japan intervention. No, it's not. This was. You should thank them, not hate them. So, anyways, wow. So the US dollar versus the yen hit a psych level and everybody took profit. Interesting. So now the next question is should you buy? Should you get back in? Well, that's where QuantBox might help. Okay, that's where QuantBox might help. Do I still have a QB open? I do. Is it the right one? It's not the right one. Oh, I think it was this one. This is where that seasonality might help out. So you're like, well, what usually happens? So you go into here, odd, yen. I just noticed it's not down there, huh? See, this is from yesterday. I have to reload my page. I wonder if I can do it from in here. No, I can't. Boop, 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 boop. Boop, 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 boop. Boop, 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 boop. All right, let's try it again. There we go. How pretty. Go to Aussie, odd, yen, beep. This might be hard for you to see, so let me shut that. Let me expand that. Okay. Very often, somewhere around September, October, we go from bearishness back to bullishness in Aussie dollar. Now, the gray line is what actually happened. Okay. You can see low, but higher low. So up. And then, yeah, it came down a little early and then it went up kind of right when it was supposed to, went way, way up, peaked kind of where it's supposed to, came down when it was supposed to. See, down, down, down. It's not perfect, but basically, okay. And, here's the week we're on now, week 40. Okay. And between 40 and 41 is not that great, but starts to work its way up. So the next few days, a bottom is typically printed. Over the last 5 years, it's been just sort of a mild recovery and then a fizzle out. Over the last 10 years, it's been a little bit better of a recovery and then a fizzle out. Okay, fizzle out around the 1st of December. So very, very soon, maybe next week, we start an upward trend that lasts until December 1st. For the last few years, it peaked earlier than that, so we have to pay attention. All right, so there's some maybe on that, right? You can see here some up, and then between November and December, some down appears. It's almost a crystal ball, huh? Well, don't overdo it, but it is useful information. When you're like, I wonder if that's a bottom. Well, most years you'll be buying very, very, very soon. Like, remember, these are just averages. There's nothing to say you can't buy it this week. You can also wait till next week. That's a managerial decision, right? Portfolio managerial decision. Maybe it's the week after. But looking at the charts, you might see things differently where you're like, I want to buy this because of yield curve control, for example. When is typically the time to buy? Well, let's say anywhere in this period. Okay. So it could be down on non-farm payrolls and then up till when? Somewhere around the third week of November to the beginning of December, right? In that period. Over the last 5 years, it would say November 15th. Over the last 10 years, it'd be December 1st. Oh, cool. So yeah, there could be some up. Okay. So how do you trade a range? You buy at the bottom of the range, and then hopefully it breaks out. You go like that. And we're right now 94 and it's changed. So maybe you can buy a dip. And, so let's say you're in at 94, going for 100. 600 pips, baby. Yeah. So, anyways, that's how it is. So, my name is Wayne McDonald. That just happened. That was Quant Box Live. I'll see you tomorrow, or I'll probably see you later today, really. So, I'll see you around. I'll see you when I see you. What day is it? Is it Thursday? Yeah. What is it? ISM today? Or did we already do ISM? Yeah. It's been a long week. So, anyways, and then Friday is non-farm payrolls. So that tomorrow's Friday? Wow. So, anyways, tomorrow's non-farm payrolls. And of course, I'll be at FX Street for that. Coolio. So, peace on earth. May the pips be with you. May our profits be above average. I'm going to do a tradeplans.ai video, and then I'll be over at forex.today. And then this afternoon, I'll be at Investor Boot Camp for the swing trading meeting. Wow, what an amazing day. And then tomorrow, I'll do non-farm payrolls live. Sweet. Lucky me, lucky you. So again, peace on earth. May the pips be with you. May our profits be above average.